Hello everyone, welcome back to the channel. In our previous video, we mentioned Japan being one of the reasons for the market crash. Wondering how? Let us walk you through it in detail. If you have missed to watch our previous video, the link is in the description. On 31st July, Bank of Japan raised their interest rate for the second time in 2024. The first one was in March when they moved away from negative 0.1% to positive 0.1%. Hold on. Even though the interest rate in Japan is not negative anymore, the governor of Bank of Japan stated that the real interest rate is still in negative when compared with the inflation. He also mentioned there could be another interest rate hike by the end of the year. Now, to understand how this change caused the global market crash, let us first understand the concept of carry trade. Carry trade is a strategy in which investors borrow money in a currency with low interest rate and invest it in higher yielding assets. For example, taking loan from country A at 1% interest rate and investing it in country B where expected return is around 8 to 10%, thereby making a profit of 7 to 9%. Now, let's replace country A with Japan and country B with the US. The interest rate in Japan from 2016 to March 2024 was negative 0.1%, meaning banks used to charge you for keeping the deposits. Investors from Japan saw this as an opportunity, leading them to borrow money from these Japanese banks at these ultra low interest rates and started investing in US stocks, bonds and other instruments where the expected return was much higher. Just to give you an idea, Japan is the largest holder of the US Treasury securities. The total holdings amounting to massive $1.1 trillion as of May 2024. That's about 14% of the total value. Now, when Japan started increasing the interest rates, the Japanese yen began to appreciate against the USD. During the month of July itself, the Japanese yen appreciated about 14% in its value against the USD. When the Japanese yen appreciated, the carry trade became difficult to hold for the investors, leading to a sell-off in Japanese and US stocks. This massive sell-off acted as an additional red flag for the investors who were worried about a slowdown in US economy and concerning unemployment data, triggering a panic sell-off in the global market. The Indian stock market is usually impacted by sell-offs in the US markets with a spillover effect. Hence, the fall we witnessed last week. So, there you have it. A quick rundown of how a change in Japan's interest rate can send shockwaves across the global markets. Pretty wild, right? If you found this breakdown helpful, make sure to hit that subscribe button and follow us on Instagram for more insights on macroeconomics and finance. Catch you in the next video.